Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, SJP Properties, Murray Hill Properties, Bank of America, Greenberg Traurig, Allied Partners. Additional funding is provided by grants from Arbor Realty Trust, Antares Investment Partners, Athena Group, BRT Realty Trust, Burden LLP, CB Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Herbert J. Sims & Company, Herrick Feinstein LLP, Helmsley Spear, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Metal Products, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Marcus and Millichap, Meriden Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Sheldrake Organization, Stonehenge Partners, Studley, Triangle Services, Witkoff Group, Extreme Contracting and Deconstruction.
Hello, my name is Michael Stoll, host of the Stoller Report, Real Estate Trends in the Tri-State Region. You know, the real estate market, people have questions of, what's happening, what's happening in the condo market, the hospitality market, the retail market, what's happening in the region. And today I've assembled 4 individuals who really have been involved and have a pulse of what's happening in the New York, New Jersey, and other parts of the country, but they're going to only focus really in the New York, New Jersey, and Connecticut market today. My guests today are Richard Mack, Managing Partner of Apollo Real Estate Advisors, Francis Greenberger, Chairman of Time Equities, Kevin Comer, Managing Partner of Beck Street Capital, and last but not least, a person who was with me on my first time that we did CUNY TV, Paul Pariser, co-founder and principal of Taconic Investment Partners. Since you were here with me in 2003 for my first show, and we were talking, it was very interesting because I still remember Paul bought a building, the 111 8th Avenue, and you said when you had to meet with your investors, the neighborhood has changed. And the big question was how people could say, who would buy a building with all those transvestites in the neighborhood? Do you remember that quote?
Something like that, yes.
Yeah, right. So, but
certainly has changed. The meatpacking district has become very different.
Right, and let's talk about the meatpacking district. You and your partners bought a year ago or 2 years ago the Western Beef situation, and this is a good example of the retail. I mean, tell my audience what you've done on that.
Well, we bought a building that was really in disrepair, but a world-class corner, 14th and 9th.
You mean Western Beef wasn't reasonable?
Western Beef is a great company, but that particular Western Beef was one they hadn't yet renovated. Let's leave it at that. And they operated on the street. It was a mess. And then they had Marked Restaurant on the corner, which was a loved restaurant for their beer, but not exactly the right presentation. The upstairs of the building had window air conditioning units sticking out. There was no elevator. It was a mess. We bought it. We got the building vacant because the contracts allowed us to terminate the leases. We had to buy out the Western Beef, and we were fortunate to go and fully redevelop it, dropped a new core in, went to Landmarks, added a floor, and finished our lease up very recently. We have Apple Computer down for about 2/3 of the building, their 3rd store in Manhattan. It's really quite lovely, and Hugo Boss and Moschino are finishing out for 2 retail spaces. And in terms of just changing the market, when we bought the building 2.5 years ago, we underwrote $225 a foot for the corner. That was $50 a foot more aggressive than anyone had been yet. We hadn't seen rents on 14th Street at that level. We got Apple in. I'm not going to be specific on pricing, but Apple came in at around pro forma when you put it all together. and Moschino and Hugo are in, and the market has basically doubled per foot. Of course, the cat's out of the bag, and other people are in that neighborhood looking. So we were very fortunate to catch a real strong trend with a very good product in a good location.
But that relates to something relating to the meat market and to you, Richard, when you had the vision to go to 505 Greenwich. People look at different neighborhoods. I mean, Francis has been around all the years, and Kevin with Bleecker Street and other things. When you went to Greenwich Street, people said, Holland Tunnel? Who wanted to be in the Holland Tunnel?
Well, the big mistake on Greenwich Street and on Hudson Street, as we followed up with, was that we built condos. And it's not that I'm not happy that we sold those condos out and did very well, but I would much rather be sitting there in that neighborhood with retail or apartments that I could ride a little foresight, as Paul had, into the future. Just to give you a sense why we went to that neighborhood is we thought it was emerging. There were new restaurants there. There were galleries. There was the Ear Bar, of course, which is, it makes a neighborhood. But we thought we were going to sell out for about $800, $900 a foot, and we sold that project out at about $1,250, $1,300 a foot, and people went on to flip those at near $2,000 a foot. So I would have much preferred to have not built a condo there in hindsight, but hindsight's always 50-50.
What, you bring up an interesting topic, and I'd like Francis and Kevin and everyone else to talk about it. Today there are about 6,000 condominiums in various stages of development in New York City, and if you want to take Jersey City and Hoboken, we're probably at 10,000. I mean, or what's the general feeling about the condo market in New York today? Francis?
Well, New York's a very desirable place to be, and it's also a place that international people from abroad want to be in. We all know about the dollar. So I think, generally speaking, while that may seem like a lot of units, I think a normal pattern of absorption should be able to absorb that in a reasonable fashion. Just to give you just some parameters, we're active. We build a lot of condos in Toronto, as an example. Toronto absorbs like 20 to 30,000 per year, every year. I'm not saying New York's Toronto. In a certain way, Toronto's, let's say, more of a growth market, but it's not as big a number as it might seem.
But what happens, today with the there is a difficulty. People are saying, maybe I'll wait to buy the unit. I mean, Paul did the Caledonia, and you marketed your condos a year ago. Probably if you marketed them today, you would have even got a higher price because of the neighborhood even getting better. But there are people out there who really are very petrified because there are a number of condo developments which are not in the best neighborhood. I mean, Kevin, you're converting an office building to condominiums, and you've done a number of other condominiums. But on the side streets or certain other neighborhoods, I'm not certain they're going to do well.
No, I think that's right. We've, going forward, it's location that's going to drive whether a project is going to be successful or not. And, I agree with Francis. New York City is, one of the most desirable places in the world to live. But we're going to have a couple of years of a very difficult time with a lot of the projects that are out there. We see, as I'm sure everybody around here does, every day a number of projects, that are being marketed as broken condo projects, mostly in the boroughs. But we're starting to see it in Manhattan as well.
And what happens to a broken condo? Okay, I'm a purchaser and I bought a condo, and now you have the rentals coming into there, and somebody says, then they're going to sue the condo developer because there's always a problem. I remember a number of my shows, I think it was Steve Witkoff who he says, I hate condos. Now he's building on Charles Street, but he said he hates condos because everybody can find a fault with a condominium. I mean, I know you're doing in Brooklyn, Francis, a very unique thing. You're doing the townhouses, which
is, well, it's part of a large mixed-use project.
I agree, but the townhouses were the first portion of it. But downtown Brooklyn today, where you are, there are more than enough condominiums being built, and many of them are not doing too well.
Well, timing is everything in our business. We were very successful with the first phase of townhouses that we built. We sold them above pro forma. The deal did extremely well. I think that clearly in the conditions that exist today, there's going to be reluctance among many buyers perhaps to step up to and make their final decision. But that demand is not going away. And, I think in our business, you can't think in terms of months, you have to think in terms of years, and, maybe you'll have to hold an inventory for a year or two. In the last serious recession, in the 2000 or 93 to 2003, we had many condo projects, not new construction, they were conversions, but instead of selling our inventory at depressed prices, we rented them. And then when the market strengthened, we sold them at prices that were unimaginable to us, even at the best of prior times. So I think if you're in this business, you've got to be flexible. There's a strong rental market out there. New York has fundamental demand. So if people don't buy, then they're going to rent.
But are we playing too much in New York by saying we're Manhattan centric? There's a demand. I mean, Kevin, you've done everything that I've known you for the number of years in Manhattan. Mm-hmm. I haven't seen Kevin Comer say I'm going to go to East Williamsburg, or I'm going to Greenpoint. Or I haven't seen Richard Mack saying I'm going to Greenpoint. And you went to the Bronx, but you've gone to the Bronx with Richard and other people on other deals.
To a lot of the people who have gone to Williamsburg and all of those places, there was a time, where you made an awful lot of money going there, and that was a lot of, opportunities that, that we were never willing to step up for.
But what I'm trying to do is I'm not looking at the past. Mm-hmm. I'm trying to talk about the present, and in the same manner, I think Paul has done two interesting things, and Richard's company has helped you in the financing, on 375 Pearl Street. I mean, 375 Pearl Street, which everybody sees, it's iconic, when you come over the Brooklyn Bridge or anything else. Let's talk a little bit about that. And
I like the reporter from the New York Times who wrote something like, it's going to be interesting to see how Taconic takes this something that looks like a GE dishwasher and makes it into a proper office building. But I just left our architectural meetings. They're spectacularly beautiful.
Will they put metal? They'll make it a stainless steel type of stainless steel.
No, it's going to be.
They look good these days.
It's going to be reclad, beautifully reclad, and we're buoyed by the fact that we have a unique product. At the end of the day, we'll have a very unique product. We'll be at absolute A standard. We'll be at 60 cents on a dollar of the cost of an A standard, which means we can bring in our rents to a tenant, to a big consumer, at a rent that's very compelling. We're buoyed by the fact that there seems to be a number of major tenants looking today, and as long as the world holds up and the marketplace holds fairly firmly, and there's action in the market. It's not racing.
Okay, but you know what? As opposed to me playing inside baseball, why don't you tell my audience what 375 was, and then Richard will tell what Apollo did on the transaction.
Well, we bought a 1,100,000 foot building in a condo format. It's interesting you said, Francis, that you sell condos, because it is in a condo. It's the majority of 375 Pearl. Verizon's keeping a few floors for a major switching operation that serves downtown. And it is a fabulous building with 15-foot clear ceilings. It's under-elevated, and it's got poor views from the inside. You can't see out of it. So our mission is really simple, to take the skin off and open up those views so tenants could have a dramatic view of New York. And we're adding probably 7 elevators and 1 more freight elevator. So when we're all said and done, it'll be an A standard building, clean 41,000 foot floor plates, very accessible to 5-minute walk for 2 different subway stops. We've got all the subway lines running in there. And we're just actually in the early stages, sort of the first or second inning of our marketing to a major corporate user.
Well, I guess our motto is, if you can't beat them, join them. We would have loved to do the deal for all the reasons that Paul mentioned, and when given I think the current capital market backup, Paul was looking for a high leverage loan on a building with no income, and we believed in Taconic and their ability to execute on their business plan. And I think we met the market and where we had to be in terms of the cost of capital, I hope, or maybe it was just more important that Paul knew we'd be there to close. But we think it's a great project, and in today's current environment, we find ourselves more and more in demand as a lender, with fewer options available to developers. I think it's going to be very, very interesting out there going forward. But I think our stint as developers, which will continue to be a big part of what we do, will be dwarfed by the opportunity that we have to provide capital to people like my fellow panelists here, in an environment where Wall Street is no longer providing 90 to 100% of the capital at very, very attractive or unsustainable and perhaps irrational rates.
But why don't we bring that up? Francis, you've recently purchased a number of buildings. Paul, you've purchased buildings. You've purchased buildings yourself. You try to purchase some buildings. And that capital, those balance sheet lenders, I mean, those are the ones who are still left. But the CMBS lenders aren't there. How is this? Is this having an effect? Have you seen prices dropping for properties, Francis, or you, Kevin? Paul?
We've bid on and have come very close on any number of projects over the last few months. And so far, we haven't really seen prices falling as much, in Manhattan, at least on the properties that we've bid on, as we would have expected. And I think that that's, partially because there's a number of investors out there that are still very, very well capitalized with 100% equity partners, whether it's pension funds or sovereign wealth funds or whoever it is. And that, for a while, I think, is kind of keeping prices up a little higher than I would have expected. We're still sitting there and we're ready to move into the market in a more aggressive way, but we want to wait for a little bit still and see what happens over the next few months. I think after the first quarter, there's going to be a whole nother round of write-downs, and that will probably continue to have a little bit of a softening effect on the market here too.
Francis?
I don't agree with that. I think there has been a softening in the market. We're under contract to buy one property at least 10% less than, this is a deal that was made within the last 90 days, and prices that were being discussed 90 days ago, 30 days later, settled for at 10% lower than were being discussed, and this is a Class A property. Darcy Stakem recently sent around a letter surveying the office market. Clearly, prices were not meeting their highest expectations in the properties that they were offering. There was at least a 10 or 15% difference between their highest expectations and
But
what
what about the financing? I mean, you recently bought...
Financing is another story.
I mean, you purchased a building on 33rd Street and you purchased a building on 36th Street. And financing, you had to get financing on that.
Well, both of those deals, one of them, 36th Street, was earlier in the year, and that was still in the good times. 33rd Street was right in the center, and when I signed the contract, I had a commitment from a major lender, and by the time it came to close, they were not able to perform pursuant to the terms that we had agreed on. And in the last minute, we brought another bank in who took the A piece, and the lender who was not able to perform took a B piece. Today, that deal would never get done on the basis that we did it.
It's gotten worse since then, you mean?
Much worse. The market today is basically 65 to 70%, where a year ago it would have been 85 to 90.
At
92.
At spreads which have probably moved 200 basis points.
Yeah, spreads, I think, well, I don't-
65% loan might have been done at 100 over.
Well, I'm talking about a LIBOR-based loan. So a LIBOR-based loan has moved less than the fixed rate. Fixed rate are clearly, you're into the mid 200s on a good day. And the LIBOR-based loans, I think, they're up, but not as much. I would say the LIBOR-based loans have gone from 150 basis points or 200 basis points to 250 to 300. I don't know.
I think that's really the whole story of value. I mean, the capital markets have changed the dynamic. The math is quite simple. If you put 200 more into the equation, or 180, or whatever the number is, and then you take more equity, you want your same sort of return on equity, you run the math, and it turns into a formula that says you pay 15% less just for that. Then you look at the difficulty of getting financing, because a lot of the lenders, and I think Richard's comments are correct. He's going to have a field day with what's out there,
Absolutely.
because he's there with a pro business and understanding the asset. If it's there, go for it. Whereas most lenders today don't even know how to play with the risk, don't want to take to committee the issues. It's just so many issues that it is difficult.
As many lenders have said to me, it's easier for us to go to lunch and just talk to our borrowers and not make a deal than to do a deal.
And a lot of our friends at Wall Street are just hoping to have their job next week or the 2 weeks from now. So
Right.
it's an upside down world, which is going to present, frankly, I think, wonderful opportunities over the next period. I agree with you. It's not quite yet. Haven't seen the bargains. We haven't seen them, but I would think that having your war chest ready over the next year, 6 months to year and a half, has to produce some very good opportunities.
You know-
at a time when it's difficult to finance, which again,
Yeah, you know, Richard and Francis are involved right now in developments of hotels. Francis downtown in West Street, Richard on Leroy Street and West 31st Street. The week before, I did a show with alternative or hard money lenders, and some of them said, we won't finance hospitality. We're a little worried about that. Why are you, who haven't really done hospitality, unless I'm...
It's not my favorite product type. We have owned and operated a couple of hotels in the past.
So why did you decide to go to West Street and build a
Well,
hotel?
in our case, it's part of it's primarily a residential condominium development, and the hotel piece is both meant to enhance the residential, as well as we had commercial FAR that we could not use for residential. So in a sense, the FAR portion was use it or lose
So
it.
you use it or use it.
So both as a factor of enhancing the residential as well as the
Richard?
Well, I still think we have strong demand for hotel right now. It certainly can be a riskier sector from a development perspective. With regard to our two different sites, they're two vastly different products aimed at vastly different sectors. One thing we learned with the Mandarin was that who we expected as our guest wasn't necessarily who our guest was. And if we could produce that type of a quality room in a more edgy, hip location, we feel we'll be able to get room rates that might be in excess of what we're getting at the Mandarin, as strange as that may seem. And so we are in discussions with our location on Leroy Street with some very high-end, what I would say chic or boutique name type of developers for a 5-6 star hotel. And we think that location, being a little bit off-piste, if you will, or a little bit off the main drag in the meatpacking district, not quite in the Hudson Square, not quite in the West Village, actually will have a distinct advantage with great water views and a lot of development going on. And that's what we've been looking very, very hard and long for a site like that, and that's why we're so excited about that. With regard to our 31st Street deal, it's a hotel that's going to be targeted at the foreign market with a foreign flag, and neither of these deals are fully negotiated, so I want to be careful what I say. I think with the dollar where it is, and with the business part of the economy stronger than the consumer spending, we're basically targeting a hotel that is going to go after the foreign tourist and business travelers, and so we think that those are two of the sectors that are very strong, and so those are very, very specific deals done for a very specific reason.
Kevin, you've done a lot of recreation, I'd say, in the retail. I mean, but with the economy not in the best of shape, do you think some of your tenants are going to have difficulties in paying your rent and achieving the sales that they've projected?
You know, it's something that we always have to look at and worry about it. We try to track it as best we can. Some of the re-tenanting that we've done, especially with our Bleecker Street properties, we've replaced one-off mom and pop tenants with Louis Vuitton credits and similar luxury good sorts of tenants, and they are going to have some susceptibility to a softening economy, but at the same time, I think that relative to a number of the other locations in the city, Bleecker Street, where we are at least on the prime blocks, I think we're going to probably stay pretty good. Now, if our rents went from $30 a foot that the expiring tenants were paying to $5.50 a foot, which they did, maybe we see some moderation in that. Maybe it's not $5.50 a foot anymore. Maybe it's $4.50 or something less than that. But we're still seeing some incredible growth off of the expiring rents of the tenants that we still have.
And the general feeling, I mean, you're building condos downtown. You're building condos I mean, they're all pre-sold, so I'm not even going to say that. I'm a little cautious about the condo market in general in New York. I mean, everybody's positive on that today?
Well, I don't think first of all, real estate business is like driving a battleship. You can't just turn it here and there. These projects all have, 3 to 5 year lead times. So if we're going into ground with a project today, it's not what will the market be in the next 12 months or even the next 24 months. It's really what's it going to be 24 to 36 months from now. And to some degree, if you can time coming out of a recession, I think history will show that pent-up demand occurs during a recession, supply contracts, so if you can get there at the right moment as the economy is coming back, it's a pretty good time to have product available. Clearly, the next 12 to 24 months is going to be a challenging period for everybody in the real estate business, including New York City.
And with that, I'd like to say that's why I put the four of you here today to talk about the state of the market, and I think the state of the market is changing. And and I think I was at a luncheon and someone was talking about steering a boat, and the problem is there are 4 different people steering the boat, and there was one person rowing the boat. So you have to find the right move. I'd like to thank Richard Mack, Apollo Real Estate Advisors, Francis Greenberg of Time Equities, Kevin Comer, Beck Street Capital, and Paul Paris for being here. See you next week.
Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, SJP Properties, Murray Hill Properties, Bank of America, Greenberg Traurig, Allied Partners. Additional funding is provided by grants from Arbor Realty Trust and Terry's Investment Partners, Athena Group, BRT Realty Trust, Burden LLP, CB Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Herbert J. Sims & Company, Herrick Feinstein LLP, Helmsley Spear, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Metal Products, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Marcus and Millichap, Meriden Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Sheldrake Organization, Stonehenge Partners, Studley, Triangle Services, Witkoff Group, Extreme Contracting and Deconstruction.